Assalamu alaikum. Welcome to lecture 16 of SBR, and today we are going to go through IAS 28, which is investment in associates and joint venture. This is very important for your question number 1 in SBR because question number 1 is a group accounting question. So in group accounting you are going to get associates. You might get subsidiary, you might get associate, or you might get joint venture, or you might get the combination of all these three. So there you need IAS 28. Okay, and almost in all the questions in your SBR, associate has been asked. So that means you cannot skip IAS 28. You are going to get it in your question number 1 as a part of a group accounting question. So here we are going to focus on the definition, accounting for associate, adjustments, and the general points and disclosure. What is an associate? An associate means when an entity has a significant influence. See, it's not a control. Significant influence. The word is significant influence over the another entity. So they are not a subsidiary. They are not the joint venture. Associate is separate. Significant influence is the keyword. Significant influence means they have the power to participate, but they cannot control operating and financing decisions. Okay. Significant influence. How will you understand whether the entity has a significant influence or not? See, in the case study, okay, if they don't give you the percentage, the percentages it's 20 to 50%. Okay, it is between 20 to 50%. More than 20, less than 50, it is known as an associate. Because if it's more than 50, less than 50 and more than 20. If it's more than 50%, if it's 51%, then it becomes a subsidiary. You have a control. And if it's less than 20%, you deal it according to IFRS 9. It becomes a financial instrument. You understanding? So between this, it's an associate. But if this figure is not given, how do you understand? In the case study, okay, they will tell you something like they have a representation on the board of director, right? They are allowed to participate in the policy decisions. All these things means they have significant influence. Okay, having representation on the board, allowing to make the decision, right? To participate, this are the meaning of significant influence. So if in the case study, what you need to see is whether they have representation on the board of directors or not. If they do, that means it's a significant influence and you need to deal according to IAS 28. Now, existence of significant influence. At least one of this following has to be there to tell that there is a significant influence. Number 1, representation on the board of directors. Number 2, ability to influence policy making. 3, significant level of transactions between the entity and the investee. Management personnel that is shared between the entity and the investee. And provision of important technical information. If any one of this is there in your case study, if you can see it, then it's a significant influence. If they give you the percentage that they have acquired 30% and 40% of the share, it is clearly understood it's a associate. So now we are going to do one small question on associate before we move on to the accounting part of associate. Test your understanding 1, Sparrow. So in this question you need to discuss whether the accounting treatment they have done is correct or not. Okay, so let's read. Here, Sparrow owns 18% of ordinary shares of Blackbird. Remaining 82% are held by hundreds of investors. So it's not one person holding entirely the 82%, but this 82% is held in small percentages by hundreds of investors. And no single investor has a holding of more than 5%. That means one is having 4%, 2%, 1%, 3%, like that. Together, if you combine, aggregate is 82%. This shows that no one has a significant influence, the 82%, and no one has a control. Okay. Now, but we are not worried about the others. We are only worried about the 18% shares in the Blackbird. Okay. Blackbird has 6 directors, and Sparrow is able to appoint two of them. Blackbird is one of the Sparrow's key suppliers. Sparrow's operation and human resource managers spend several days a year at Blackbird in order to ensure trading between the two entities is smooth as possible. In the consolidated financial statements, the directors of Sparrow wish to account for the investment in Blackbird as a financial asset. So do you think this is correct? Is the 18% share a financial asset? You might say yes, because I told you just few minutes back that because this is less than 20%, it is dealt according to IFRS 9, financial asset or a financial liability, right? Because here it satisfies that criteria, it's less than 20%, 18%. You might think like that, but see, whenever they give you information other than just that percentage, through that percentage you cannot, you might say it's not an associate. But if you are given other information that they have key supplier, they can appoint, things like that, then you have to read and see if it satisfies the other criteria, one of those following 6 criteria, then you have to deal it according to IAS 28. Then it's an associate, even if it's less than 20%. Okay, so I'm not writing the answer. The full answer is there. You can read it, but explanation needs to be there, right? So you might say significant influence does not exist because less than 20%, right? 18% is less. But even though through the percentage is not there, but significant influence does exist. How? They are able to appoint 2 out of the 6 directors. And also they are the key supplier. So this is number 1 reason. This is number 2 reason. What else? High level of transaction is there between the Blackbird and the Sparrow. You can see that, right? That they spend several days a year at the Blackbird to ensure trading between the two entities is smooth as possible. So you can see high level of transaction. This is the third point. And there is an interchange of management personnel between the two entities. You see, they are sharing human resource managers. So this is number 4. So there are 4 reasons to say significant influence does exist. 1, the key supplier, transfer of human resource, significant amount of transaction, and able to appoint 2 directors out of the 6. So all this 4 concludes significant influence does exist. That means this should be accounted as an investment in associate, not a financial asset. Now let us go to the adjustments for associate. So moving into accounting for associate. Okay, accounting for associate. When it's an associate, you do not consolidate their financial statement. Okay, associates are not consolidated. Why? Because they are not part of a group. Investor does not control them, but you use equity method for them. Okay, investment in associate is shown as a non-current asset. Okay, it is shown in the non-current asset section of the consolidated statement of financial position. Okay, it's just one line item we are showing. Through equity method we are going to find the investment in associate. Okay, and it is shown in the non-current section of the financial position. But we are not consolidating line by line the assets, the liabilities of associates like how we do for subsidiary. But the associates income, the expenses, then their assets, liabilities will be given the same way how for subsidiary it's given. But the only difference is we are not going to consolidate them line by line because we are going to use equity method. And this is how we do the equity method. We start with the cost. This cost will be given to you in the exam. Okay, what is the cost of investment in an associate? With that, you add if it's a profit or minus if it's a loss. Okay, you add the P's percentage of post-acquisition reserves. What is P? P means parent's percentage, parent. Okay, post-acquisition reserves, that means all the post-acquisition profit after the acquisition. After you have bought that associate, whatever the profit is, only up to the percentage of P, the parent's portion you are taking. Okay, P stands for parent. Then if it's an impairment loss, you deduct the associate, this thing. Then P's percentage, again the parent's portion only. Any unrealized profit is deducted. if P is the seller. If the parent is selling to the associate, you take it out. Okay. See, unrealized profit when there is a transaction between the parent and the associate. Okay. Any unrealized profit, okay, and any transaction between them, the unrealized profits needs to be eliminated. Okay. And any excess P's percentage of excess depreciation on fair value adjustment. You might be given some fair value adjustment, right, which you didn't adjust before. So because of that fair value adjustment, now you have excess depreciation also. Let's say there's a increase in fair value of the land, or let's say leave land, let's say building. So in that, because the fair value increased, on that increment, you are going to charge depreciation, the excess depreciation. Only the piece percentage you have to take, the parents, and deduct the parents percentage only. And then what you get is known as investment in associate. This is what equity method is known as. You have to memorize it. You have to know it. You have to take the post-acquisition profit, only the parents. Deduct the impairment loss. Any unrealized profit, if P is the seller, deduct. Any excess depreciation, deduct. But only the parents percentage. Okay. Now, in your statement of profit and loss, for an associate, it only makes up a single line item. That is, okay, to do that single line item, you have to do this calculation. You start with the associate's profit after tax. Okay, from that profit, you only take the parent's portion. Okay, and deduct the impairment loss, and deduct any unrealized profit if associate is the seller this time, and any excess depreciation, the parent's percentage, and what is known as share of profit of associate. Sometimes you are given the share of profit of associate as it is. Sometimes you have to work it out like this if you are not given, to find the share of profit of associate. So in your statement of profit and loss, only share of profit of associate will go. To get that, you have to know this. Okay. Now, okay, so you have to this thing. Just give me a minute. Okay, can you see here? There's a reason why I came back to the previous slide. See, this is in the consolidated statement of financial position. Okay, you are only worried about the P, the parent, the parent's profit. If you see the fourth line, parent's percentage of unrealized profit if P is the seller, right? That means whoever is the seller is going to realize that, is going to have that profit. Whether realized or unrealized is a different thing, right? Who is going to have the profit? The one who is selling or the one who is purchasing? The one who is selling. He is going to recognize that profit, right? So if parent is the seller, parent is going to recognize that profit. You understand? So in the consolidated statement of financial position, when you don't take the associate's profit. You are not care about it. You don't care about it. Why? When you consolidate, it is only the parent. Only the parent's profit you have to take, parent's percentage of it. So here if you see, because it's in the consolidated statement of financial position, right, you take P's percentage of unrealized profit if P is the seller, parent. Correct? Coming back to here, if you see here, this is for statement of profit and loss, and here you are taking third line, P's percentage of unrealized profit if associate is the seller. You see there's a difference. Why associate is the seller? Because we want to work out the share of the profit of associate only. So for that associate only has to be the seller for them to have that profit, not the parent. Whether we take the parent's percentage or not out of that profit is a separate thing. But it is associate needs to be the seller to find the share of profit of associate. In the consolidation, we are taking the parent. So that's why there needs to be the parent who is the seller, and here it is the associate. When we want to find the share of profit of associate, it is the associate that needs to be the seller. You understanding? So this is the little difference that I wanted to take you through. Now, It is just not the profit. Sometimes you might be given other comprehensive income. If you are given, you have to find out the associate share of other comprehensive income if it's applicable. Okay, that means within consolidated other comprehensive income, the group should present its share of the associates other comprehensive income. Okay, the group's percentage of other associates other comprehensive income needs to be given. Definitely we are going to do 3 questions in this lecture, so you do not have to worry if you feel this is too much for you to memorize or take, or you are forgetting. Okay, now we are moving on to the adjustment. Any dividends that is received from the associate needs to be removed from the consolidated statement of profit or loss. And any transactions between associate and the parent, they are not eliminated. See, earlier in a subsidiary, what do we do? Intergroup transactions we eliminate. Here we don't do that. Why? Associate do not form part of a group. I repeat, associate do not form part of a group. You do not control them. You just have a significant influence. So you do not eliminate any transaction between the parent and the associate from your consolidated financial statement. What about the profit? The group's share of any unrealized profit between the group and the associate needs to be eliminated, because you are actually not having any profit, the unrealized profit. So you eliminate that. You only take the associate's profit and keep it, but the group's share of that profit you eliminate when the transaction is between the group and the associate, needs to be eliminated. You need to memorize these adjustments, by the way. When you do questions, calculations, numbers, right, you need to know these rules. You don't have to write it, but you have to know it in your mind. What are the adjustments? Okay, here if associate is the seller, what do you have to do? If parent is the seller, how the adjustments are different. Pay very clear attention to this. A little difference in the word who is the seller changes entirely everything. So if associate is the seller, you debit the share of the associate's profit. Why? Because associate is going to recognize that profit. You understanding? The one who is selling is the one who is going to earn that profit. So that's why you debit their share of profit, associate's profit. In the statement of financial position, it is the retained earnings. Okay, from retained earnings you debit, and you credit statement of financial position from inventory, because when you sell from your inventory, it will be, your inventories will go down. And when associate is the purchaser, that means parent is the seller, you debit cost of sales and or debit retained earnings. And where do you credit? Investment in the associate. Okay, investment in the associate. So know this difference. Okay, coming to the disclosure. So these are the following things you need to know regarding IAS 28. What is it? Financial statement, okay, of associate and the parent. See, the financial statements used to equity accounting for the associate should be drawn up to the investor's reporting date. Sometimes the reporting time, the reporting period of the associate and the parent might be different. You understanding? They might have different year end. So in that case, how do you do? How do you deal with it? See, the reporting date for the associate should be drawn up to the investor's reporting date. You have to do it. If this is not possible, then what should you do? Difference in the reporting dates should not less than be 3 months. Let's say associate has a reporting end of 31st Jan, whereas for the parent it is 31st March. Oh no, not 31st March. We'll keep it 31st. Sorry, for the parent, for the investor, it is 31st December year end, and for associate, wait. Sorry. Okay, yes. Associates year end is 31st December. The investor's year end is 31st March. You see, there's a difference. Associates reporting in 3 months before the parent. So there's a lack of 3 months. Okay. So if you cannot cover up that, at least the difference in that reporting day should be less than 3 months. It should not be more than 3 months. You should keep up to that. Okay. How you do that, how not to do that is not our concern. You don't have to know it. Just know this rule. The difference should not be less than 3 months. Sorry, should be less than 3 months. It could be 1 month, it could be 2 months. But if it's 4 months, it cannot be. Okay. Then associates accounting policy should be in line with that of the investor. Right? Then investor should disclose its share of the associates contingencies. This the investor should do. So that's it for this. Now we are moving on to the 3 questions before we summarize IAS 28. Illustration 1. Consolidated statement of financial position. In your SBR exam, you might not be asked a full-fledged consolidation question, but parts of it only will be asked, right? But this is a very good question to start your IAS 28 or even consolidation, right? Because it is everything and it's a full-fledged question. Even though you will be asked only extracts or part of it, I would advise you is to start a full question. Now you have to do a full consolidation question. That is the best way you can learn. The earlier you learn, right, a full consolidation question, if you know, then making extracts, just being part of it is very easier rather than you doing the other way around. You just cannot start with the part or extracts of it and then going to the full consolidation question. It doesn't work that way. You first have to do the hard work, then you come to the easier one, right? Because doing a full consolidation question, I know it takes time. You might be thinking it's not worth it because you used to do this in your financial reporting, F7, to prepare a full consolidation question. But here, in your professional level, SBR, you don't do that. You might have to interpret, you might be given some number, you might need to you might be asked a discussion question on it, right? Whatever it is, but you should know it. Okay, the best way to revise again a consolidation question is to do a full 1, 2, or 3 questions. Okay, so here you are given the statement of financial position of the 3 company, Borak, High, and Street, and some information, and then you have been told to prepare the consolidated statement of financial position. We are going to do that. But before that, you need to read some information. Okay, so 1st of July 2007, Borak purchased 45,000 share. So see, you have not been given the percentage. Have you given the percentage? You don't know who is the parent, you don't know who is the subsidiary, you don't know who is the associate, right? So for that, you have to read this information. He purchased 45,000 shares in High for 100,000. Okay, at that date, Highs, that means at that date means acquisition date. This is acquisition date, okay? High's retained earning was 30,000 and there are no other components of equity. Their net asset, High's net asset had a fair value of 120,000 and fair value of NCI was 55,000. Policy of NCI is at fair value. Nothing to worry. Then excess of the fair value of High's net asset over their carrying amount at the acquisition date relates to property, plant and equipment. So that excess in fair value is because of this property, plant and equipment. This has a useful life of 5 years. Why did they give you this? For depreciation. Okay, and they have been given the goodwill which is impaired, and it is impaired to 7,000. On the same date, he purchased 10,500 equity shares in Street for 21,000. That time their return earning was 25,000, no components of equity. Now he sold goods to High. See, that means this one is the parent. You know that. But whether High and Street, who is the associate and who is the subsidiary? Or are both associate, or whether both are subsidiary? At least see, because they asked a consolidation question, in this case, at least one is always a subsidiary. Okay, don't just assume, but this is based on the pattern we are saying. Okay, at least one subsidiary they will give you for sure, or they might give you 2 subsidiaries, or they might give you one subsidiary for sure, and the other one is going to be an associate. If it's less than 20%, if it's not an associate, then you have to deal according to IFRS 9, financial instrument. It could be a financial asset. Okay, but let's see. We have to work it out. Okay, so Burrock sold goods to High for 10,000 at a margin of 50%. By the reporting date, High had only sold 80% of these goods. Included in the receivable of Burrock and liabilities of High are intergroup balance of 5,000. Whether we have to eliminate this intragroup balance or not, you cannot decide. It is decided whether he's a subsidiary or an associate. Then, on 5th of July 2008, you see this is after this date. It's after this date. They received notification that an employee was claiming damages against the result of workplace accident that took place on this 30th April 2008. That is before the reporting year end. Lawyers advise there's a 60% chance that they are going to lose the case and they are required to pay 30,000. There are so many small standards that you need to deal with when you're doing a consolidation question. And this comes in your question number 1 in SBR for 30 marks. So are you ready, guys, to do this? Okay. First, deal one by one. Finish with High. Understand what is High. High, how do you know whether how to work out since we are not given the percentage? You have to see from the shares. Okay? You have to see from the shares, equity shares. See, you have to work out from here. This is the starting point for High. High it is 75,000. And how many shares did brought 45,000 in High? So from 75, you have bought 45 shares. Okay, if you take it in terms of percentage, you have to find it in terms of percentage. It is 60%. So 60% is more than 50%. It's a subsidiary. So you can write next to it, High is a subsidiary. You need to consolidate it line by line. Coming to the street. Okay. Go down. 10,500 was bought. So out of this, 10,500 was bought. Same way you have to do. Here I'll do 10,500 out of 35,000 in terms of percentage, how much it will be? It is 30%. Less than 50, more than 20. It's an associate. This is an associate. You do not consolidate it line by line, but you use equity method. Okay. So, when you do working, you need to show this working. Okay, this comes under working. This could be working 1, both of this. And you can name it as group structure. Never forget this in your exam also. You need to do it. This is your first working. First working is to find out. So through your shares, you can find out what is what. Okay. Now that you know, you can start with the working. First working is start with the net asset. Net asset is usually the first working. I mean after the group structure. So, okay, I will do it here. The working next to it itself. So working 2 is going to be net assets of High. Okay. Do we need net assets of street also? Tell me. Do we? No, we don't. We don't need required for street. Why? Because street is an associate. We only need net asset of High, which we are going to consolidate. Okay. So we are going to make two columns. One, it is at accusation date and at reporting date. That means in the statement of the financial position. Okay. So you always start with your equity capital. You have to see your statement of financial position for that. Here we have equity capital, this we have to take. Retained earnings, this we have to take. Other components of equity, this we have to take. Okay, with two extra things, that is depreciation, excess depreciation and fair value adjustment. But these three things will go, liabilities will not go. Okay, only equity part. So equity capital, if you see at accusation and reporting date, accusation, see equity capital will be same. It will not change. Okay, so it will remain 75,000 only. At the accusation date also, even at reporting date, you might think that they purchased 45,000 at accusation. Then why 75,000 at accusation date? No. This 45,000 share is given for you to find out in percentage whether they are associate or a subsidiary. But equity capital, when you're finding the net asset, it will be 75,000. Whatever is given in the statement of financial position, it will be same. At accusation also, at reporting date also. That will not change. So 75,000, 75,000. Okay. Imagine if they have given you the percentage. Like normally in your question, they give you that they have bought 35%, they have bought 50% share, they have bought 60% share in this company. That time they don't give you the shares, right? You don't use shares that time. So it's the same. So just because they told that they bought 45,000 share does not mean at accusation you are going to write equity capital 45,000. No. Imagine they didn't say how many shares they bought and they just told, okay. Directly they told 60% share is bought. This is we have to find out through number of share. Imagine if they just directly gave you 60%. Then we don't have to do that working. The working one is not required in that case. Okay, that is only for to find whether it's an associate or a subsidiary. That's it. Other components of equity. OCA. At accusation, it will not be there. Only in the reporting period, other components of equity are there. That is 5,000. Only equity capital remains the same. This nothing is there. At reporting date is 5,000. Then we are moving on to retained earnings. Retained earnings at accusation date you have to find out from other information. You see here? Okay, I'll highlight it for you. 30,000. And here, when you go to the other reporting period, you have to take this 50,000. You see? So 30,000 and 50,000. Then comes fair value adjustment. Because net asset, see net asset means asset is taken in your statement of financial position, doesn't it? So that fair value adjustments you take. Fair value adjustment. On that depreciation also you charge. So fair value adjustment is how much? See, sometimes they give you the fair value adjustment, sometimes they don't give you. In this case, they didn't give you the fair value adjustment. They just told that fair value is due to, that excess fair value is due to property, plant and equipment. They didn't give you the value. But they told that the net asset had a fair value of 120,000. They already give you the fair value of net asset. So that means through this 120,000, you can find out the fair value. That means this is a balancing figure in this question. You are given 120,000. So find out the balance. 75 plus 30 minus 120. Difference is 15,000. Okay. Here also it will be 15,000. No depreciation in the accusation date. Depreciation only comes at the reporting date. How much? This 15,000 They told it's for 5 years. Divide by 5, which is 3000. You deduct. And once you do all the calculation, it will be 142,000. Try it on your own and see. Are you getting these numbers or not? You have to get it. Then we are moving on to working number 3. Goodwill. After net asset comes goodwill. Why? Because for goodwill, you need net asset and you need purchase consideration. Purchase consideration, how much you have bought it for, is already given in the question. Net asset you just found out. With that, you can find the goodwill. You see, follow that logical order. There's a sequence that you need to follow. If you have started with goodwill, you will not be able to find out because you need net asset for goodwill. So the goodwill's working is, are we going to find goodwill for for street? No, because he's an associate. We only find goodwill when we have purchased a subsidiary. So there is going to be one only. With this, you add fair value of NCI and you deduct fair value of net asset. So how much did you buy that? You bought it for 100,000 and net non-controlling interest is 55,000. You see, so 100,000 and NCI is 55,000. Net asset you deducted acquisition, which is 120,000. This one, and then goodwill is 35,000. You have an impairment of 7,000. Don't forget, it's already given in the question. So 7,000 is your impairment. Okay, then 28,000. This is the goodwill at reporting date. Now we are moving on to working number 4. After this, it is your NCI. Normally this order is followed in any question, right? You start with fair value. Fair value of NCI. This is given as 55,000 already. With this, you add the NCI's percentage of post-acquisition profit. After that acquisition, whatever the profit is, the NCI's percentage you have to take and add. To do this, it's very easy. You are already working 2, right? Just find the difference between these two to find what is the profit. You see, at acquisition, your profit was 120. It increased to 142,000. So that increment is the post-acquisition profit. 142,000 minus 120. Okay, see, this comes from working 2. You can mention like this. From where did you get this 142 and 120? From working 2. Again, mention in working 4, mention working 2. You understanding? Inside the working, there's a working. And you take percentage. What is the NCI percentage? 40. Because you bought it for 60%, so 40 is the NCI. It will be 8,800. Now you deduct the goodwill impairment. NCI's share of goodwill impairment. Which is 7,000. So you take 40% of that 7,000. Which is 2,800. It will be 6,000. Sorry, it will be 60,000. Just give me a... I'm sorry, it is not 60,000, it is 61,000. It is 61,000. Sorry. Now we are moving on to working number 5. All the group reserves. Okay. So we have group retained earnings. Group retained earnings. Group retained earnings always starts with the parent. Always starts with the parent. Whatever the parents retain earning that day, it is 200,000. So you start with 200,000. Then you take one by one, step by step, for high, for street. Okay, you have to take both of, see, even if it's an associate or whether it's a subsidiary, you have to take their share, parents share, right? So share of post acquisition profit you have to take for high and for street. For high it is 60%, and for associate, whatever the associate's percentage. Associate was 30%, so 30%. Okay, retain earnings. Okay, so post acquisition earnings, if you see here, you see retain earnings was 30 and 50. So the difference is the post acquisition. Wait, hold on. No. Hmm, Just give me a time. Okay. Yes. So here you find the difference. You see retain earnings from 50 to 30, the difference, and then this depreciation you have to take. This 3,000 you have to take, right? You always need the previous working, so that's why you need to follow an order of that working. Okay. This you will only get through experience. The more and more questions you do, you will automatically understand which working comes under what. So here it is 50,000 minus 30,000 minus 3,000, the depreciation. Also you have to deduct and take 60%. It will be 10,200. Then for this one, okay, you see retain earnings for street at acquisition date was 25,000, and here it is 40,000. So the difference, okay, so it will be 40,000 minus 25,000, okay, which will be 4,500. Okay, after that you have to take the group share of, group's share of goodwill impairment. For goodwill impairment, if there's any goodwill impairment, you have to take the group share. Goodwill impairment was 7,000. Okay, and if you take 60% of 7,000 is 4,200. Deduct. Then we have what else? Everything else is done except two things. One is unrealized profit. Parents unrealized profit, PURP. For this we need a separate working. This goes under working 6, which we haven't done yet. And then we have what? What is that? Provision. Remember the last para? All these are expenses. This also needs to be there. So this working number 7. So let's leave some space. We'll go and start with working 6. Which is parents unrealized profit. Okay. Provision, sorry, it's not parents, it's provision for unrealized profit. Sorry. So there is a profit on intra-group sale. See, for that you need to read this. Okay. Sold goods 10,000 at a margin of 50%. Okay, and 80% they have sold. That means 20% is still remaining. And 5,000 is in the balance. Who is selling to whom? Understand who is the seller. Borok had receivable, liability of high. Okay, Borok is selling. He is the seller. The parent is the seller here. So here, the profit on that intra-group sale is how much? 50% of 10,000, which is 5,000. This is the profit. Okay, and they told unrealized profit, realized profit, URP. They told they have sold 80%. That means 20% still remaining. So out of this 5,000, 20% is still remaining, which means it's 1,000 unrealized profit. Now, who is the seller here? Parent is the seller. When parent is the seller, okay, you debit retained earnings, credit inventories from the parent. One thousand, debit 1,000. So you go up and you minus 1,000. Coming to provision, working number 7. Right? We need to see. This is dealt under 7. This paragraph, IAS 37. How? You need to read some information here. Whether there is an obligation or not. See, the obligating event, that is the accident, happened during the reporting period. You have to see when the accident happened. It happened during the reporting period, right? Because they told it took place on 30th April 2008, this workplace accident. And this was before 30th of June. So that means an event had happened. There's an obligating event. That means there's an obligation from the past event that you have to pay. That's why you have to make a provision. How much? Of 30,000. Of 30,000. And even the payment chances of paying is also more than 50%. That means you are more likely to pay. Right? 30,000. You don't take 60% of 30,000 and calculate. No, it is just to find out whether there you have a provision or not. Whether you have to recognize, whether you are likely to recognize a provision or not. For that only they gave the percentage. So it's 30,000. Okay. How this will be charged? Debit retained earnings and credit your provision of 30,000. So you go there and you deduct 30,000 from your retained earnings. And you finally find, which is 179,500. Now we come to other components of equity. Which is the parent. Then you take the share of post acquisition other components of equity, which is for high. You take their percentage. So for parent, if you go and check, it is 10,000 and here it is 5,000. Okay, so other components of equity is nil in the acquisition date. Okay, it's only 5,000. So for parent you take 10,000 and for this you just take 60% of that 5,000. which is 3,000. And then 13,000. We have one more, which is working number 9. That is investment in associate. You see, after you have done everything for subsidiary, finally is one item, which is associate. This is very small work. And this is our main focus of this lecture also. Investment in associate. Okay, you just have to write the cost. You have to add a share of retained earnings. So the cost, you bought it for 21,000. This is, we are talking about street. Street is an associate, right? And share. You see, in the statement of financial position, their share of retained earning is 40,000. But in the information they told, at the acquisition date it was 25,000. You take 30%, which is the associate, which is 4,500. And you add it. This cost you have to take. I'll show you. This 21,000. You have bought shares in street for 21,000. This is the cost of investment. You see? So you add both, it is 25,500. Okay. So you're done with all the workings. Now what you need to do is, you just have to make the group statement of financial position. I'm not going to make the group statement of financial position, but I will show you from here through this. Okay. So property, plant and equipment, okay, will be, you add with 100, you add 80,000. Okay. And then you don't add 60,000 because it's an associate. But with this, you add another 15,000. Cut this. 100 plus 80 plus 15,000 because there's a fair value adjustment of 15,000 and depreciation of 3,000. Deduct. And finally you should get 192,000 from your property, plant and equipment. Okay. Then investment cancels off. Okay. This is in the consolidated we are talking about. Okay. But we have two more things. One is goodwill, one is investment in associate. So you can write here goodwill. Goodwill we have calculated as 28,000. Then you can write inventories receivable and cash equivalent will be there. But somewhere before inventory receivable and cash goodwill, you can write investment in associate. Which is 25,500. Okay. Now I'll erase all this so that we have more space. Okay. Now current assets. For current assets, we just have to add 22 with 30,000. We don't take 15,000, but we deduct 1,000. Remember, from unrealized profit, we have to deduct it from inventory because we credit inventory in the statement of financial position. So you minus 1,000. Then you will end up with 51,000. Then we have receivable. Receivable also you add this to and you deduct the intra-company balance. Okay, minus 5,000. So 70 plus 10 minus 5, which is 75,000. Then cash and cash equivalent, you just add 47 with 25,000. This goes out 72,000. When you take all, it will add up to 44,300. It includes both your non-current and current assets, by the way. Okay. Now we are moving on to equity capital. It is to balance, by the way. So equity capital, only 100,000. This cancels out. This cancels out. Only 100,000. Other components of equity, sorry, retained earnings. Wait. Retained earning, we have calculated it, 179, 500. Other components of equity is 13,000. And then one more thing we have to add, that is non-controlling interest, which is 61,000, which adds up to, okay, liabilities also will add there. Liabilities is 50,000 plus 15, cancel this, minus 5,000 because that is the intra-group balance, plus 30,000. Remember, this 30,000 is the provision that will go under the liabilities, okay, which will add up to 90,000. 90,000 is the liability. So if you add up, it adds up to 44,3,500. This balance, right? It balances. So that's it. You see? Now we are moving on to second question. Test your understanding 2. Illustration 2 is consolidate a statement of profit or loss. Here you have to prepare statement of profit or loss, consolidate it. Okay. Here also you have been given the two companies, and here if you see how it is different from the previous question is you have been given the percentages directly. So they own 80% in S and 30% in A. So we know S is subsidiary, A is associate. Wow, coincidentally it matches with their letter. Okay. Same way, line by line, we do not consolidate associate. So there were no other items. There are no items of other comprehensive income in the year. At the date of acquisition, fair value of SS plant and machinery was at 10,000. Okay. During year S sold goods to H. Here the seller is the subsidiary. You need to understand this. 10,000 margin of 25,000, and they sold 60%. That means 40% is unrealized. Okay. Their accounting policy, group policies to measure NCI at proportionate share of net asset. That means you will not be given the fair value of NCI. The current year goodwill impairment loss was 1,200. This should be charged to admin expenses. And investment in A has been impaired by 450. Current year loss was 150. You see, it's a loss they have been given. And on 1st of Jan 2008, this is for 6 months only if you see from this date. H signed a contract to provide a customer with a support service for the following 12 months. H received the full fee of 30,000 in advance and recognized this as the revenue. This will be dealt in IFRS 15. You need to know all the standards. So before you prepare the consolidated statement of profit or loss, we need to do the workings, how we have done for the previous question. So let's do that. Here we don't have to do the group structure because we already know through the percentages that S is a subsidiary, A is an associate. Okay. Net asset and all we don't have to do here because we are not doing the statement of financial position, right? Only the items that will affect your profit and loss, only that working. So here, this case, your working two could be your depreciation that you need to work out. Okay. If you see here, they told fair value exceeded by 10,000. Okay. And what is the remaining useful life? They've not given it. Okay. So they told that which at the time had a remaining useful life of 10 years. Sorry, this is not often. This is of 10 years. Okay. Of 10 years. So it will be 10,000. This is working 1, sorry. Divide by 10 years, which will be 1,000. Okay. And then comes your working 2. It could be, okay, intragroup, let's say intragroup trading, intragroup balances. So this intragroup balances, you see how much they are selling to each other. The intragroup, 10,000. They sold 10,000. Out of this 10, see, this needs to be eliminated, okay? This is subsidiary. This has to be eliminated. And the profit part, you need to work out on two things separately. One is the sale part, sales. The other one is the profit, 25%. Okay, on this 25% and 60% is sold. So here you need to eliminate. How do you eliminate? By debiting revenue. You have to remove this from your revenue, from your sales, this 10,000. And you need to credit this in your cost of sales. From there also you have to remove it, 10,000. Now relating to that profit part, profit. So profit on that will be, margin is 25%. So 25% of 10,000 is 1,000. Sorry, 2,500. On this 2,500, 60% has been sold. That means what is remaining to find unrealized profit? 40%. So 40% of 2,500 is 1,000. This 1,000 is unrealized profit. So for this, you debit cost of sales. Unrealized profit also you have to eliminate. 1,000, and you credit inventory. From inventories you have to remove this. Who is the seller here? Subsidiary is the seller. That's why you're debiting their cost of sales. Okay. Now, what else? Working number 3. That is revenue. Remember the revenue that you have to do? How much revenue you can recognize? You need to understand whether a performance obligation is satisfied at a point in time or over a period of time. Definitely, I have not done IFRS 15 now, but anyway, through your financial reporting, you know the ruling of IFRS 15, right? In detail, we'll go through it when we go in depth in IFRS 15 when I do that lecture. But for now, you know that revenue you recognize, okay? That is the last stage. But before that, you need to know whether a performance obligation is satisfied at a period, at a point in time, or over a period. This is over a period. Why? Because you're providing services for the following 12 months. So performance obligation here, it is satisfied over a time. How much percentage of work have you completed? Up to that percentage only you can recognize the revenue. So you see, on 1st of Jan, they sign a contract for 12 months. But you have to prepare only for 30th June, only 6 months. That means only 50% of the revenue you can recognize. So out of this 30, only 50% you have to take and recognize. That means only 15,000 you can recognize as revenue. Understanding? Remaining 15,000 needs to be removed from the revenue because you have already recognized 30,000 as revenue. So that 15,000 you have to remove. And it should be held as a liability. So you debit revenue 15,000, and where do you credit? Contract liability 15,000. And the final working number 4. How do I know how many workings are there? This is based on experience, you will know. Okay, basically these are the workings. Whichever the information is given to you around whichever area, that many workings you need. Here you have revenue in this para, so one working is for that. Here we have Goodwill impairment and all, we don't require working because straightforwardly they have given you the impairment directly. Nothing to work. Here it's about selling intragroup. So you know another working is required. Yeah, here it is net asset, fair value. So another working is required. That's how I know. Now it is profit to NCI. Because see, subsidiary we are acquiring, right? So NCI part we have to work out. Profit. Profit to NCI needs to be worked out here. To do that, okay, you first work out the S. S is the subsidiary. Profit for the year. Okay, from there you deduct unrealized profit. Provision for unrealized profit. Excess depreciation. First do and then you take the 20% because NCI is 20%. So what is their profit for the year? SS profit for the year is already given. That is 39,000. So 39,000. From there you deduct provision for unrealized profit, which is 1,000. Depreciation is also 1,000. Once you deduct, you end up with 37,000. On that you take 20%, which will lead up to 7,400. Now you have been given all the information. Okay. Now, one more thing. Two things you have to note here regarding goodwill. Goodwill has been already calculated using share of net assets. Okay, therefore none of the impairment loss is attributable to the NCI. See, which goodwill method was used? Proportionate. Proportionate means partial goodwill. Because partial goodwill method is used, you do not have to attribute anything to NCI. Otherwise, goodwill impairment loss, you have to take the percentage to NCI and for the parent. Here you don't have to do that NCI percentage because it is partial goodwill method. Entirely it is for the parent. Regarding the provision for unrealized profit, this one, if the parent had sold goes to the subsidiary. If the parent would have sold, then this adjustments will not be included when calculating profit attributable to the NCI. Why? Because here we are finding out for the NCI percentage, right? That means the subsidiary is selling it. Because subsidiary are sold, that's why we are realizing their profit. We are taking 20% on their profit. If it was the parent, parent would have realized that profit. We would not include it in NCI. You understand? If parent was the seller. So now, with this understanding, okay, we are done. Same way we are going to do here, line by line, we are going to consolidate. So 500 plus 200,000, we don't take this, but we deduct the 15,000 revenue, the contract, right, from our last working, which will be, revenue will be 675,000, sorry. Then cost of sales, you add 100 with 80, there is no 40,000. Okay, you add 1,000. Okay, the unrealized profit, wait, it is the excess depreciation, I'm sorry, because they told it is in the cost of sales. So in the cost of sales, this first 1,000 is depreciation, okay, D, because there are two. Then you deduct 10,000. What is this 10,000? It is the sale that you have been eliminating. Intragroup sales, right? Intragroup sale, IGS. And then you are adding another 1,000. What is this 1,000? This is unrealized profit. First 1,000 was depreciation, this one was unrealized profit. So it will be 172,000. Gross profit, don't add 400 plus 120. That's not how you do gross profit. Gross profit you do after this number 1 and number 2. 1 minus 2. So gross profit would be 503,000. After that comes distribution cost. Distribution you just add 160 with 20. That is 180,000. Then we have admin. In admin, we add 140 plus 40. Okay, we don't take this. But we add one thing. What is it? Goodwill impairment, because they roll it in admin expenses. Plus 1,200. So it will be 181,200 you deduct. Okay, and then profit, which is 141,800. Then you deduct, sorry, profit from operation. Once you get profit from operation, what's next? Share of profit of associate. See, before tax, it comes before tax, okay? Share of profit of associate. Okay, it is 30%. 30% on what? Profit of associate. What is the profit of associate? It is 26,000. On this, you take 30%. So 30% on 26,000 minus impairment. Minus 150. There is an impairment of 150. Which will end up to 7,650. Then profit before tax is 149,450. This is profit before tax. Then tax you just add this to. This will come down, a little down. 23 plus 21,000. You don't take this, which is 44,000. This is tax. Okay. 105,450. Okay. Just give me a time to find that impairment. Okay, so impairment they have already given you 150. Wait, here you see current loss. Investment in A have been impaired by 450, or on which the current year loss was 150. So you have to take the current year loss of 150. That's why you minus 150 when you are taking the share of profit of associate. Understand? Now, after the profit for the period, you need to attribute it to this among equity and NCI. NCI, equity holders of the parent, or I would say just parent. NCI you have already got as 7,400. So this is the balance, which is 98,050. Equity, parent is always a balancing figure. Okay. So that's it for this. Now we'll be moving on to the last question, which will be the extract of both statement of profit and loss and statement of financial position. Illustration 3. Here you are supposed to prepare extracts from consolidated statement of financial position and consolidated statement of profit and loss. Only the extract and only the treatment of associate that is needed, right? That means this requires less work than the previous two questions. So let's see. On 1st of July, they acquired 30% of Animate for 2 million. That means it's an associate. At acquisition date, fair value of their net asset was equal to their carrying value, but except with one building. Okay, this building had a remaining useful life of 10 years. Carrying value was 1, fair value was 1.8. Between 1st of July to 31st December, that is 6 months. Okay, everything is for 6 months here. You see, you have to time apportion everything. Because even they acquired also on 1st of July, but you are supposed to do it for the year ended 31st December 2001, only for 6 months, not for one whole year. Okay, so between this date, Animate sold goods to Paint for 1 million, making a profit of 100,000. All these goods remain in the inventory of Paint. Sale was made on credit and the invoice has not yet been settled. Animate made a profit after tax of 800,000 and they believe associate need impairment by 50,000. Okay, so everything has been given. First, you need to do the workings to arrive to the extract. It's just the extract is just one line you have to write, not the entire statement of financial position or not the entire statement of profit and loss. So starting with statement of financial position. Okay, what you need to do here is consolidated statement of financial position. I'm writing the short form. Okay, here investment in associate comes under non-current assets. Okay, investment, this is just an extract. You need to show where it goes. Investment, so you write this as investment in associate. Okay, we write working one. For this we have a working one. Now that's it, only one. Now coming to consolidated statement of profit or loss, right? Here we only need one item, that is share of profit of associate. This also needs a working two. That's it. So now we are moving on to working one, investment in associate. Okay, for investment in associate we use equity method, that is we start with the cost. That means at what cost did you buy associate? At, you bought it at 2 million. Okay, so 2 million. After that you are going to add the share of post acquisition profit. Okay, what is that? It is at 30% of post acquisition profit. See, they have already given you the profit. It is 800,000. Only for 6 months you have to take. Okay, so if you take it like this, it will be 120,000. After that you have to take share of excess depreciation. Remember that fair value, it's an expense, so you need to deduct it. That will be again 30% of what is the value of the asset. Carrying amount is 1 million, fair value is 1.8. So, and it is for 10 years, useful life is 10 years. So 1.8 million minus 1 million divided by 10 years into 6/12 for 6 months, it will be 12,000. And the impairment, the total associate is going to impaired by 50,000. So once you do that, you are going to get 2,058,000. This is the investment in associate. See? So this exactly this amount only you have to write here in the extract, 2,058,000. Now coming to the share of profit of associate. Working number 2. Okay. So you start with the P's share, that is the parent's share of A's A's profit, associate's profit. So it is 30%. Okay, even though we say P share of A's profit, we only take associate's percentage only, 30% only, not the other way around, 70%. No, profit was 800,000 into 6/12. It will be same, 120. Impairment you have to reduce because it's an expense. Sorry, it's 50,000. Yeah. Then we have excess depreciation. Depreciation. Depreciation is also, we have already calculated here, isn't it? So I'm not doing it again. The 12,000 excess depreciation. Okay. Then we have one more thing which comes as provision for unrealized profit. Okay, you see 30% of 100,000. See, unrealized profit is 100,000. You see here, you are selling and they are making a profit of 100,000, but all the goods remain in the inventory. So it's entirely that 100,000 is unrealized. You just have to take 100,000 of it, which will be 30,000, which you have to deduct. And then it will be 28,000. This 28,000 is the share of profit of associate, which you have to write in the extract here. Okay, that's it for this. The only thing that you need to remember is, see, regarding the provision for unrealized profit, okay, you need to see who is holding the inventory. The inventory is held within the group. So the parent share of the provision for unrealized profit is credited against inventory. That means it is reduced against the inventory rather than investment in the associate. When you were calculating investment in associate working number 1, okay, we didn't take it against the investment in associate. Rather, we credited it against inventory because it depends who is the seller. Is the associate or is it the parent? Right? And to recall that, you have to go back and recall that. Who is the seller? If the parent is the seller, what happens? If associate is the seller, what happens? Okay, so that's it. That rule is only applied. So that's it. Now we'll be summarizing IAS 28. So we have come to the end of IAS 28, and we went through the definition. We said for it to be an associate, it has to have a significant influence, and the percentage wise 20 to 50%. Accounting for associate, it is equity method, and you do not consolidate like subsidiary, right? And in your statement of financial position, it is shown on a non-current asset as investment in associate. We have just seen a question previously how to do it, and in statement of profit and loss, it is under operating profit. Adjustments are dividend received are removed. Dividend received from associate needs to be removed. Transaction between parent and associate are not eliminated because they are not part of a group. Group share of any unrealized profit needs to be eliminated between the group and the associate. So this is it for IAS 28. We'll be seeing you in the next lecture. The next standard is going to be IAS 32. That is a financial instruments presentation. And till then, don't forget to subscribe to my channel if you haven't subscribed, and please do questions on group accounting. Since we have covered IAS 28, we have more group accounting standards to do, which we have not covered yet. But still, with this knowledge, you can do the questions on associate. So see you in the next lecture, and thank you and take care.